Welcome back. You're still tuned into Trading Hour. Well, Jio Flexicap Fund NFO subscription closes today. Rishi, who is the CIO at JioBlackRock AMC, is joining us now to discuss the NFO, who is it suitable for, and detail the NFO for us as well. Rishi, good morning. Thank you so much for joining in today. So the Flexicap Fund, which focuses, of course, it's a Flexicap, so equity instruments, there'll be debt instruments, there's REITs and InvITs as well. But you have the systematic active equity strategy here. If you can explain more of that, how is it different from any other Flexicap fund that we already have in the market?
Sure, thanks. Happy to be here firstly. And yeah, on the SAE approach, so BlackRock has this global division called Systematic Active Equity, SAE, which is around $300 billion, one of the largest systematic managers globally. We are getting that approach to India for the first time through this Flexicap Fund NFO. The differences are quite a lot. So one is, of course, it's Flexicap, so the benchmark is NSE 500. And we can straddle across large cap, mid cap, small cap in those 500 stocks. But yes, the entire process is fully systematic, as the name suggests. And we are focusing on risk-adjusted returns also, apart from just returns. Obviously, the goal is to have attractive alpha in the long run. But what the BlackRock SAE approach shows global markets across US and other emerging markets also, is that you can do it with lower risk. So obviously, it's a long-only fund. So we will rise and fall with the market. But when you are underperforming, any long-only strategy will underperform, have certain patches. There, we want to have very low deviation on the downside in terms of underperformance and have that volatility very low. So for example, a lot of active funds which do very well, when they outperform, they'll outperform 10-15%. When they underperform, they'll underperform also by a large magnitude, but still may reach a good, end goal over the long run. For us, we want that downside deviation to not be typically more than 3-4%.
How will you ensure that? That is why this...
Yes. So there, now the systematic process, what it does is, firstly, it takes a lot of data. So obviously that data and technology is the core of this. And it takes not only traditional data, which are fundamentals and flows and other things, but also a lot of alternative data. So almost 20% of the model is alternative data, which are things like, to share simple examples, credit card swipes, online transactions, job postings, message discussion boards. So there's a lot of this unstructured data which you can structure and then get some real-time insights from it. And those can be almost real-time, right? Real-time, daily, weekly kind of signal. So some of that is faster moving and gives you some advanced insights. So for example, if a company launches a product and suddenly the sales spike based on your online sales or credit card swipes, you get a good indication that, something is going to change there. So some of these things are something which is not being used in India at all ever, and something that the fund is going to use. And then in the whole optimization process, which we run on Aladdin, our end-to-end tech platform, there not only the alpha scores, which is like a relative return expectation of one stock relative to the others, but also risk and cost goes into that modeling. So basically the portfolio that comes out is risk optimized, risk controlled, cost controlled kind of portfolio. And that makes it very, very different from all other Flexicap funds. Also, that ensures that it's a much more diversified portfolio. So the number of holdings is much larger than other Flexicap funds. But it's a little counterintuitive that, typically in India, we think that if it's a very diversified portfolio, how will you get the alpha? But interestingly, the approach shows that, it is possible to do it because the way the systematic process is structured, there is a lot of focus on actually stock-specific alpha. So the sector exposures, stock exposures, there are what we call bounds around it, right? So that is where the fund managers can come in and say that if there's too much news flow, for example, happening in an IT sector, then, the normal data is not going to impact it. So instead of, say, a plus minus 3% weightage constraint we have on that sector compared to the benchmark, let's tighten it to plus minus 1 or almost have benchmark exposures. But at other times, let it run as per whatever the model wants to run.
Will there be more churn in that case? Because you said 20% of it will be basis, say, credit card swipes. If a product is saying more demand, there will be periods when we'll see that, right? So how does it churn?
That's a good question. So we have a weekly rebalancing approach, meaning that on a weekly basis, the data will get updated. Now, that doesn't mean the entire portfolio will churn on a weekly basis. The weekly rebalancing time horizon is more from this faster data approach, that whatever faster data has to change, we at least give it a chance to come into the portfolio updation process if something is very important, it'll change the portfolio on the margin, and at least it'll keep reacting over the next few weeks. On an average, every week around 3% churn happens. Some weeks it's lesser, some weeks higher. And obviously because 80% of the data is still traditional, right? Where the majority of it gets updated on a quarterly basis. So that will still drive it largely, but the weekly thing helps us be a little more reactive to quick changes that happen. GST, tariffs, some of these things is something which has been recently much talked about by all of us. There obviously everything will not change, but on the margin, important changes that have to happen will start happening as well.
Rishi, firstly, it's a Flexicap fund, right? So what is the equity to other asset class mix ratio? And since you mentioned about the weekly changes, you spoke about how you will be faster to change, but on the flip side, would that not result in more volatility? Is it resulting in regular changes? You have to keep monitoring the fact that, okay, this will change this week, this will change that week, and so on.
No, sure. So see, there is, as I said, larger number of holdings. So what happens is still, because we are not deviating from sector and stock exposures in the benchmarks too much, so the top 60-70 stocks will still have the larger weightage, right? So there's a long tail that is out there, which is small exposures, obviously, which will be more of the smaller stocks. But that happens because, as I said, the risk and the cost estimates is also going into the optimizer, right, which is generating the portfolio. So if a small cap stock, for example, has a very high alpha, let's say on the horizontal side, compared to a large cap, and then based on risk and cost, that net, attractiveness of alpha reduces, then it still gets some weightage because on that weightage, its risk-adjusted returns is the best. But it obviously will not give it a very large weight. And usually that churn we are talking about, 70% of it is just weightage changes on the same stocks, up and down. There's only 30% which is actually stocks going in and out. And that will be on this tail which has very small exposures. Now, because the cost estimates are also going into our modeling, right, which is impact cost slippages when you are trading. So therefore, the cost is the only worry if you're rebalancing on a weekly basis. That is not a worry for us because it's already optimized for cost.
Got it. So we understood a fair bit about this NFO. So Rishi, we have a lot more questions, but we are out of time. So this conversation for some other time. But thank you so much for joining in today and explaining to us everything about the strategy and interesting trends that you're looking at as well, and the ways to, modify the portfolio as well on a weekly basis in terms of churn and other factors that you're considering to build this portfolio. That's the word coming in from JioBlackRock AMC, the new Flexicap Fund, the NFO, closes today for subscription. With that, we'll do one thing. We'll slip into a short break. When we come back, we'll discuss market fundamentals with Gautam Bed of Complete Circle Stellar Wealth PMS. Stay tuned for that conversation.